What's up, guys? It is the 21st of June. Another Friday's on us. We're going to get closer and closer to the end of this month. That's going to be the rear view mirror. And then, of course, before I know it, 2024 is in the books. So we got Patrick McCarroll back on. I promised I'd get him. And here he is. We want to hit one thing, though, before we get deep into the market and the other bullshit. And Patrick's also knows of some of the things he's seeing on his side. You deal mostly with owner-occupied stuff, right, Patrick?
We do. We do a small percentage of investment transactions, but most of which is owner-occupied.
And you're out in Texas, and they deal a lot with just people buying investment properties across the country. That's why you're tuning into this particular update. So one thing you're going to see a lot right now, it's going to probably cause you a lot of alarm. You're going to get pro formas from people providing housing, and you're going to look at the projected principal interest, and then you're going to see the taxes. Then you're going to see the insurance. Think, okay, this is pretty decent. Then you're going to get your insurance information directly from your insurance agent. After we've ordered it from them, then you're going to be like, damn, that's way more expensive than I thought it would be. You're going to get frustrated. You're going to call me and say, Aaron, what the hell's going on here? And one of the things that they're going to tell you is because the lenders are now demanding that they do 100% replacement cost on that house. Now, this has been a Fannie Mae rule. They've been asking for this for a very long time.
Yeah,
we just now decided or have been pretty much put into a chokehold as a lender and say, you're freaking doing it. Now, let's talk about this a second. You as a real estate investor, like, there goes my cash flow. I was making $400 a month cash flow on this house. Now I'm making $300. Not a good deal anymore. Guys, before, the only coverage we cared about as a lender was enough coverage to pay off the loan. If you got that, that's all we gave a crap about. But because of the enforcement that's going on, I don't have direct information about this. I've not been there, but I can only guess. They usually start to really enforce things when somebody's going to the attorneys and somebody's filing a lawsuit. And I've had these phone calls come. I've had people call me up, say, listen, my house burnt down. I had $100,000 equity in it. And there's just enough insurance to pay the mortgage off. What about my equity?
Yeah.
And you're pissed at me. You're like, you should have forced me to get the other. It's amazing how people love to point the finger. Now, what's interesting is you're going to point the finger at the lender saying, you guys suck. You're sucking up my cash flow, pound sand. But if it's flipped around the other way, where we get to the cheapest, we were allowed you to get the cheapest type of insurance there is, just paid off as a lender. And now you have that equity gone. Not only is the equity gone, but now you have this big burnt pile of rubble on this lot. And the city's like, you got to get that cleaned up. That's a health hazard. Get to work. That's $30,000-$40,000 to haul all that off. Then you got to rebuild to make a business at it or just let it go. You're 130 grand in the hole because you want to make a little bit of cash flow.
Yep.
This way it prevents you from having this as a risk. So what if it's $80 a month? $80 a month, so you are never, ever, ever upside down? What are your thoughts, Patrick? What are you guys going through?
Yeah, I mean, it's the same thing. And I think one of the things that we're experiencing is that construction costs have skyrocketed, right? So if that property is going to burn down and you've got to not only pay off the loan balance, but then you have to have the capital needed to rebuild that property, you've got to make sure that you can bridge that gap, right? And not get caught in a scenario where, hey, to rebuild this structure, now I've got to invest 40 grand of capital out of my pocket in order to create that, to bridge that gap. So we're seeing that as well. But interestingly enough, here in Texas, we're beginning to see insurance companies that are not writing policies in particular zip codes. I was floored by this because we had an insurance agent that sent us an email as a team and said, hey, by the way, we're still writing in Tarrant County, which is where I reside in here at Fort Worth. So I sent the email to my team and I'm like, hey, this is funny. Why would this guy say that? And they said, no, this is real. We're running into obstacles where insurance companies are coming back saying, hey, we're not even going to provide service in this particular area. So it's become a real problem and struggle on all types of purchase transactions.
Because, I mean, look what the insurance companies' risks are. If they're putting in certain areas because the cost of to replace that is so enormous, the insurance company is going to put themselves out of business. That's the big risk we're dealing with right here with all this crap that's gone on. There's so many dominoes that are starting to fall from what happened with COVID and that whole mess, especially with supply chain, everything. It continues to cause grief. Then we get into forced inflation. That's the main topic that Patrick and I get into is the inflation thing. What do we got coming up? We talked about CPI last week. That's all that news. It was a little bit is off of what people anticipated, right? But now what do we have in our near future?
That was a big market shock for sure. The big hits coming next week. We not only have GDP forecast on Thursday, Then we're going to roll right into the Fed's favorite inflation gauge, the personal consumption expenditure, abbreviated to PCE. So that bad boy's coming out on Friday. Markets are going to be looking really closely at what that number looks like.
So since those are, well, let me just take a quickly look at the charts of how things have reacted to CPI and the other news that we received. Now, guys, I'm looking at a specific coupon I like to track because of certain types of deals that I'm doing, certain times that I tap into this coupon. And you can see because of CPI, we bounced out of that channel, went back up in here, and we have found, and I talked about this particular line, I marked it as purple. I talked about it way back here. I think this was going to be our new ceiling. This is our ultimate ceiling, unless the Fed influences it and puts a ton of money. And this is what I believe is our new ceiling as far as traders would want to put their money in and believe that there's value beyond it. Well, anytime anything got pushed above it, price action, bring it right back down. This has become quite the attractant. And as you can see, every time it's come above it, we just get right back on it. Tried to open up high today, pulled right back down. So any thoughts on that, Patrick, on how it is that is it basically just tension building right now for movement within this PCE and the what are the other metrics this next week? My mind just went blank.
Yeah, no, GDP and PCE. So yeah, I mean, it's if you have access to the 10-year chart there, I don't know if you can pull that bad boy up or if you've got it open, but it really feels as though, and I don't want you to don't lose that chart there. If don't lose that chart, open up a new one if you can. If you can go to your original page, yeah. So that way it doesn't erase all that data. But it's really interesting that, the market price is based upon where they believe the value is, right? And the biggest key that I've noticed is kind of looking back, and it's hard to dictate, right? Because credit spreads last year were as much as 360 basis points, right? Which is the difference between the 10-year treasury and 30-year fixed rates. But that's shrunk to about 100 basis points as to where we are right now. So it feels like what you're seeing there is we're 4.2 is really where everything really begins and starts, right? If you go back and look at the past 12 months, if the 10-year yield can get below, say 4.2, that's your vaulting point of being below a 7% interest rate, right?
There we are, right there. There's our 4.2.
Yep. Market participants really do have not demonstrated the idea to be below that. So if you see that bottom surge from 2024, right, that was the rebound when the market said, hey, no, we're not going to get 6 rate hikes. And then it was like, no, we're not going to get 5. Then we're not going to get 4. And that was that build all the way up to almost 5% again. But as we've settled to the idea of potentially having 2 rate hikes or rate cuts, sorry, is what the CME group is kind of protecting at this point. The Fed's still kind of holding their cards and not showing anybody anything. But what you're seeing there in that blockade of MBS prices is also existent there at 4.2. And that kind of seems to be the spot where investors just market participants haven't been willing to break there.
And so there hasn't been enough reason, enough value, or enough for those traders to say, hey, we're going to break this barrier. You're getting on it, right? That's that same ceiling. Yeah. It'd be a floor in the treasury because you look at them inversely. But exactly. that right there, that floor, they can't. It just seems to be a really, really, really strong area. It pulls it towards it, but it can't break through it. Same thing with our MBS. It's just getting there, but it's not breaking it. So if I can get this thing to stop.
So the interesting piece then comes into play. It feels like we're just going to roll here through the summer. Like you and I talked about previous too, we're starting to see some evidence. The Bloomberg Surprise Index, the Citi Surprise Index are at the lowest levels in over 24 months. And what those are is, again, they direct and dictate when market indicators are coming in lower than expected, right? So there's some rumblings that the Fed maybe is behind the 8 ball a little bit, that the Fed's behind the curve and that things are actually slowing faster than what the Fed is actually recognizing. But it's a guess at this point, right? Because the Fed doesn't feel like they're behind it.
That I'm wondering if because I don't hear the market talking about it a lot. You talk about these other indexes over there. Well, the Fed's behind the curve. You have somebody as much as Elizabeth Warren coming out and talking. When she starts talking, some stupid shit's about to get said, and her trying to direct what the Fed should do. But okay, we're talking about inflation. Supposedly, we got the surprise index. Hey, it's coming a little bit better than what we thought it would be, but nobody's talking about what's happening, what's going to happen to inflation in the U.S. dollar now that you have Saudi Arabia saying, We're not doing petrodollar anymore. There's going to be an effect here. We're not sure what it is. And I would hope to think Powell's ignoring the noise and saying, we got to see what's going to happen here before we start making any sort of moves, and probably not publicly talking about it. Because think about when people understand the dynamic of that, that's a panicking thought that the US power across the globe has been the petrodollar. That's what's kept our dollar alive. That's what's kept our dollar any value whatsoever. The dollar's lost a stupid amount of value. That's just not, let's not even try to even guess on that. 1993, I walked into a Taco Bell and was able to buy 2 bean burritos, 2 tacos, and a drink for $1.99. Why does that stand out in my mind? It's the first Taco Bell I ever walked into in Moses Lake, Washington. Then fast forward to 2023, this is 30 years later, that exact same product. My daughter wanted those exact same things in a drive-through, $15. That's a 750% difference in 30 years. That's why having a 30-year fixed mortgage is the most important decisions you can make. But think about that. The dollar lost that much buying power in 30 years. And that was with us having strength globally with the dollar being the reserve currency. Now we're starting to see that break. That's an alarming thing to consider. So I don't know that surprise indexes or all these other things are really going to be able to have enough horsepower to make any sort of dent when we know that that's looming overhead.
Yeah, the biggest, when you bring topics like that up, the most controversial piece then becomes it robs the ability to print money as we did through COVID, right? As long as we remain that reserve currency and the strength there, we have no problems with those financial decisions. But when you're sitting at debt that's 130% to GDP, right, then that becomes a really massive problem. And when you're talking about Treasury debt on an annualized basis, that is now almost $1 trillion a year for the first time in history. And it's the second most allocated expense when factoring in overall tax revenue, right? So, I mean, you're talking 15% of allocated tax revenue is now having to directly go towards Treasury yield debt on an annualized basis to make those payments. So that becomes a much grander problem, right? Just talking about, it's a big deal.
Problem. Yeah, and
Yeah.
to even narrow it down to even correlate that with, hey, is the Fed going to lower rates? Almost sounds like infantile to have a discussion. But that's another thing that people need to think about. Is like, I hear so much. When are they going to lower the rate? When are they going to lower the rate? We don't know the unintended consequences of lowering the rate. It's going to be much bigger than what we think of just, it's going to make it easier to buy a house. Guys, if rates on houses get much lower anyway, the price of your housing goes so damn high, you're still not going to afford them. It's not going to help you.
That's the biggest key that a lot of people don't take into consideration. And when you went through the algorithms, and I posted this on social media yesterday to all of my business partners and agents, is that 6% changes the game, right? It's if we get to 6%, you're going to see a mass number of sellers that are already in the marketplace, because that's going to be the place where I've gone past waiting for rates to go back to 3, right? And I've been sitting in this stagnant place of 7 to 8% interest rates for 2 years. If you go down to 6, that's when you kind of go, the gamble's not worth it anymore. Like, this is my entry point at this time, right? So then not only are you there, you're more affordable for buyers. It becomes much more complicated to engage and purchase real estate at that moment.
Agreed. I also think it's going to really, really push some prices up. We get there because of how many people jump in. But I also think there's going to be a lot of dumb people thinking, well, it's on its way down. Guys, 3s aren't happening again. They just can't. If they did, it would be extremely destructive to our economy. But got final words here, brother?
Yeah. I mean, back to what you said there is watching the inflation data is absolutely important. I think one of the keys, if you're somebody who wants to sit at home and you want to have an idea of what's happening, look at jobless claims. I think if we hover stationary around 225,000 a week, that's a pretty significant space. If we break that, obviously it's positive to the mortgage market. Interest rates would be lower at that point through there. Anything under that's going to keep interest rates well elevated, but that's another secondary place to really look and consider when you're trying to get an idea of the market direction.
Man, well, I appreciate you taking the time as always. Thank you guys for watching. The subscribe situation so you can be alerted next time I have Patrick back on. You guys have yourself a hell of a weekend. I'll talk to you on Tuesday.